Eric Muather, Muather.com, for the weekend of November 5th and November 6th, 2016. Let's take a look at world market charts here. Before we do that, let's take a look at how markets closed. We can see, let's call it pretty much a down session on Friday for most of the world markets. So down sessions across the globe. In Asia, take a look at European markets at the close of Friday, and we can also see another down session. So what was a down week for the most part. Let's take a look at the Americas with about 1 hour to go before the close, and we can see here that, let's take a look at what, and with about an hour to go, the Brazilian market is up. We can see the Canadian market is slightly down, and we can see S&P 500 is unchanged. Let's take a look at those world charts. Let's begin by taking a look at the Australian market, and what we have here is the same bearish look we've been talking about for many weeks, if not many months. It is this previous break that brought the market off the highs of 2015. This is a long-term monthly chart going back to 1990, and we can see here we stalled about 3-4 months ago when we hit that level. So that's one layer of resistance that stalled the market. A second layer of resistance comes from the top side of the monthly RSI. We hit that level, and then there's also a third line, which is a backtest failure line. So let's take those two because that chart would be too busy. And we have also this line here that is offering support, or did offer support many months ago. So the Australian market for now still shows a bearish look, even here after the first trading week of November. Now if you take a look at the 2-year weekly chart, there is some possibility of support now that it's pulled back. In fact, if you go back to the highs here, this was almost easy to call, because once the market had broke below here off the highs of 2015, in the last couple of months the market had rallied all the way back to that level. And once we hit resistance here, we were expecting a pullback, and of course we already got that pullback. So that's behind us. In the current market, there is possibility of support if you take the RSI lows line, something like this. So at the conclusion of this past week, this is where one can expect some type of support. If the market can hold that, that would be a suggestion that the market wants to at least start moving higher, if not stabilize. And the other line comes from this entry off the lows. This RSI entry brought the market off the lows of early this year, and we've been higher since. We draw a line from here, something like that. You can see that if the market can bounce on the blue line and the green line, that would be good enough to stop the current slide. If we take a look at China, we can see here that it is now above the recent weekly closing high here that we were watching. So that's a slight breakout. The level we were watching there was 3,108.10. So we are above that. As long as the market can hold above that, it might have a chance of moving higher. And also keep in mind that we have a good crossover between the moving averages. Here we have the 13-week moving average crossing above the 34-week moving average. As long as it can maintain levels above 3,108.10, that is a slight breakout that could actually attract movement to the upside. There's a challenging area here, because if you take a look at the previous break line on the weekly RSI, and this is three years worth of weekly data, and just draw the line like that, you can see that ever since we broke below that line, during this period here, we broke below here, market's been coming back and showing resistance on this blue line, even here, and now we are back in this general area. So the challenge is whether the market can hold above this level. If it can hold above this level, that's good. Otherwise, if it shows resistance on the weekly time frame on the blue line, and more so if it moves below this level, that would be a sell signal. So for now, net it looks either sideways to positive, but if it cracks back below this level, one can expect that the next meaningful direction is going to be lower. If we take a look at the Nikkei, we can see that it also has moving averages that are crossing over, which short term looks bullish. So moving average between 13-week and the 34-week moving average. Now that looks good. And we can also see the problem here is that short term there seems to be some type of resistance on this 2-year weekly chart. Come back to this break here. The break that brought the market off the highs of 2015. Draw a line from there. And you can see that this has been resistance once before for this period, late 2015. And now we're coming back. We've tagged that over the last 2 weeks and we seem to be stalling. So the challenge here is whether the Nikkei can move above this line of resistance. Failure to move above this line of resistance suggests that the next swing trade is going to have to be lower. In fact, if you take a look at a longer term picture, let's take a look at a 5-year weekly. You can see there's another line that offers resistance going back to the lows here in 2012. Just extend that line. You can see this was support during the period here and here. But ever since we broke below that, right here, the market has been using this for uniform activity rejection. Uniform activity rejection here for these highs. And now we've hit that with uniform activity. We seem to be stalling. In fact, there's also another instant here in April of this year for the highs there. So until the market can move above this line and the previous line we drew, which is somewhere here, one can assume that this market continues to be under some type of a resistance around current levels, and potentially the next meaningful direction here continues to be down. If we take a look at the Indian market by way of the Nifty, if we go back to the previous analysis, that there was a breakout attempt here that failed, and for a couple of weeks we've been saying that this failed breakout was not a good sign. Why? Because failed breakouts are notorious for taking markets lower, and this is exactly what happened here. We've been drifting lower. This past week the market was down about 2.3%, and we can see one of the reasons why the market was down a little bit substantially was because it moved its weekly RSI below 50. Whenever you move above or below 50 on whatever time frame you're looking at, you tend to have a huge reaction lower. So that is consistent with what we've been analyzing here, that the market more than likely was gonna pull back. But now I can see here a reason why we could start expecting a little bit of a support level, and it goes back to the same weekly chart. Take a look at this short-term breakout. We can even say the breakout here in late March. So this slight movement here brought the market off the highs, or off this level here, the slight breakout. Market still above that level, so that was a good entry, and we can take that entry level and draw a line from there. This line happens to be at about RSI 50 on the weekly, and you can see market's been bouncing on this. In fact, the last time it hit that level here, there was a nice double bottom, which is support on the RSI 50 and support on this green line. You can see that we are coming back now. In essence, if we can bounce back above the 50 level, something like that, then this is where the market finds some type of support. So, I would argue that this is a logical place to expect a little bit of a support zone. Otherwise, failure to hold here, and if the market stays below 50 on its weekly RSI, then we can expect much lower prices. Now, keep in mind the problem here is if you take a look at the long-term picture, long-term picture doesn't look that great. And why is that? Is because take a look at this breakout attempt on the weekly chart that failed. So that's not a good sign month to month. Also keep in mind that this breakout attempt here came with the RSI making a lower high. RSI also failed to move above 61.8. And this is the worst type of negative divergence, which means that we can actually logically now expect a huge correction. So the problem is the monthly chart continues to have that same look and feel for a market that wants to go down. And keep in mind, if you draw a line right there, as I've been saying for a long time, movement below this red line has been a problem for the Indian market. You can see here, off the highs of 94, we broke below here, off the highs of 2000, we broke below here again, off the highs of late 2007. We stalled here on the line off the highs of 2010, 2011. So the problem here is that we are below this red line. After coming and trying to move above the red line, the market was rejected, and that's not a good sign month to month. Now also short term, we can take a look at the daily chart for the Nifty, and the level that it needed to be holding support right now looks like it is not, and it is this level here. Why that level? Because it is where it began the movement of the lows. This RSI movement here brought the market off the lows there, and for a successful bounce since then. So we draw a line from there, which is where one was expecting some type of support. As of right now, it looks like support has been blasted through, and this becomes a risk for much lower prices unless the market can find a way back above this green line. Looks like right now chances are the risk still remains to the downside unless the weekly chart finds a reason to bounce. So keep in mind, we closed just a little bit below RSI 50. If the market can recapture back above 50, expect some type of a sharp reversal in the new week. Otherwise, failure to move back above RSI 50 on the weekly time frame still suggests that the downside pressure continues. If we take a look at the Euronext ETF, actually not the ETF but the Euronext 100 market, we can see that the biggest risk on this 3-year monthly chart, the biggest risk is that here we could very easily move the RSI to 3-year lows. In fact, we're very close to the RSI moving to 3-year lows. If that happens, that's a huge red flag. We can see that the main MACD right now is just about to move to 3-year highs and also move below zero for the first time in a couple of years. So the problem here is RSIs and MACDs moving to 3-year lows might suggest that potentially, if this happens, we are setting up for a market that is gonna be moving much lower. So that's the risk based on this chart. If you take a look at the German market, we can see that the DAX has been pulling back, consistent with what we had observed, which was it had come back to test the break off the highs of 2015, and so we had drawn a line from here. Market had tried to move above this line on multiple occasions but failed during this period, and now we are seeing a rollover, which is what we were expecting. Now keep in mind, we had a relatively big down week, down about 3.5%. Why? Because the weekly RSI moved below 50. Again, as you move below 50, you tend to have this reaction to the downside. Now around here, one can expect some type of support based on RSI lows line coming into play. If you connect the RSI lows coming back from the recent lows here, you can see that if we can find support here, the market might have a reason to bounce week to week. And just like we saw with the Indian market, if it can move back above RSI 50, expect a strong snapback rally whenever it moves back above RSI 50. And on the daily, it needs to find support on this RSI lows line. So on the daily, if it can find support on this line, that might be a good reason for the next meaningful direction in terms of a swing trade to be for a bounce. Otherwise, if you break below this potentially support line, then we can continue expecting lower prices day to day. Take a look at the Footsie. Just like we saw with the Indian market, there was a breakout attempt here a couple of weeks ago that failed. And once that failure to break out took place, we were expecting a pullback, and this is exactly what we got. It's consistent with a failed breakout. Keep in mind, we had also observed that the market made an improvement in terms of weekly price highs, but the RSI did not do the same. In fact, the RSI made a lower high. So that negative divergence set the stage for a pullback. As we've seen with the Indian market and the German market, on the weekly, we can see that there's a trend line on the RSI that could come into play. So as we begin the new week, we can see that if it can find support here, that might be good enough for the next swing trade to be to the upside. Otherwise, failure to hold support and breaking below this line might suggest much lower prices. Keep in mind, the monthly chart is absolutely bearish at the present moment. If you take the RSI highs on the monthly RSI, you can see that it connects to where it stalled this past 2 months. And as long as the market is showing resistance on this line, clearly we can expect that month to month, this monthly chart is suggesting to expect an even bigger correction. If we take a look at the daily for the Footsie, it looks like it broke support. If you take the RSI lows line, as of Friday's action, it broke below that. That's not a good sign of where the market wants to go in the coming weeks and the coming months. Also, if you take a look at the ideal entry of the lows of 2016, so this entry here brought the market off the lows there, and so it needed to find support on that line. So a line from here is where it needed to find support. Problem is we broke below that line. In fact, we broke below the green line and the blue line. This might be a sign that now the market is broken, and that potentially, even with the bounce here and there, that eventually the market might have to drift lower, unless the market can move back above those two lines with uniform activity. Just like it did here, it went below the green line and back above it with uniform action for the lows right here. So the key is whether it can find itself back above the green line with uniform action. Otherwise, again, it looks like we are below those two lines. RSI lows line on the daily has been broken, and the previous ideal support line or the uniformity line has also been broken. It's not a good sign as long as the RSI is below these two lines. Take a look at the Canadian market here with about 15 minutes to go before the close. We can see that it also needs to find support on this daily RSI lows line. If this can hold, maybe the market can stop the recent slide. Otherwise, failure to hold this line and movement below this line could be bearish. Now keep in mind, the possibility of a break below this RSI support line on the daily is very high. And why is that? The reason being that on the monthly, long-term monthly chart, this looks very bearish. If you take a look at the recent break, this trend line break brought the market off the highs of 2015 here. So off the highs there. So we draw a line from there, which is where we stalled, or where we are stalling right now, right there. So the problem here is that it looks like month to month, as long as the Canadian market is down for the month, it confirms resistance on this level. And that's not a good sign. In fact, if you backtest the same line, you can see that this line, by the way, happens to be at about 61.8. So we need to pay attention to it. We can see here uniform activity rejection as you try to move above the line and back below it for the highs there. Uniform activity rejection here for the highs right there in 2008. And then also we see a trend line break right here. That trend line breaks corresponds with this break off the highs of 2000, and also this break here. There was another trend line break right there that corresponds with the movement off the highs of early 98. So we can see the problem is here long term. This is where the market has been stalling, and the monthly chart continues to show that stall. As long as we are down for the month, we can expect that this is a serious breach, and that ultimately this market looks to be pointing down for a huge bear market pullback. Now, sticking with the long-term monthly chart, take a look at the EWZ, which is the ETF that tracks the Brazilian market. And here we have a problem also in terms of the chart. Right now looks very bearish. Just go back to this break This break in 2010 brought the market off the highs there. Draw a line from there. Should be something like that. You can see eventually it confirmed resistance on that line for the highs there. And again here, rejection for the highs of 2014. And looks like here it is confirming as of right now the highs for 2016. So this monthly chart by itself suggests that even the Brazilian market looks to be pointing down in the coming months. Keep in mind, short-term day to day, there's a chance here that the market could find support on this line right here, connecting RSI lows. So if this line can hold, that's good. That might hold the market together. Problem here is that the monthly charts are very bearish. I would speculate that even if it finds support short term, that eventually it's going to have to come back and break below this line of support. Why? Because the monthly charts are very bearish. Eric Muaded, muaded.com. Let's see how things go. Good luck. Enjoy your weekend. Peace and blessings. ESS.